Welcome to ValueVest Daily. Just a quick reminder right up top before we dive in, this explainer is strictly for educational purposes, and it is not financial or tax advice. Please always do your own research and consider speaking with a licensed financial professional before making any investment decisions. Now, with that out of the way, I want you to picture something. We are constantly flooded with news about tech companies posting great quarters, right? They beat expectations by a few percentage points, their stock bumps up a bit, everyone cheers. But every once in a while, a company delivers a report that completely shatters our understanding of what is fundamentally possible in manufacturing and hardware. Today, we are unpacking one of the most unbelievable financial reports in modern market history, delivered by a company sitting right at the beating heart of the AI revolution. I am incredibly energized to break down these massive numbers with you today because what is happening here is completely redefining the entire technological landscape.
Just think about the sheer scale of this number. When a mature, established tech company has a stellar year, you might expect to see, 10%? Maybe 20% growth? If they're surfing a massive new trend, maybe you see 50%. But the chip company we are looking at today didn't just grow by 50%. Their revenue grew by an absolutely staggering 346% in a single year. They're nearly 4.5 times bigger than they were in the exact same quarter last year. To truly understand how rare this is, we have to contextualize it. If a software company grows 346%, sure, it's impressive, but software is easily scalable. You're essentially copy-pasting code. But this is a hardware company. They deal in physical materials, chemical etching, multi-billion-dollar clean rooms, and massive, complex global supply chains. Achieving 346% growth in physical hardware is an absolute manufacturing miracle. Because of this explosive growth, the stock just shot up to over $1,200 a share, propelling the company straight into a $1 trillion valuation. The company I'm talking about is Micron Technology, and it has rapidly become the most fascinating single-stock story in the entire market.
Okay, let's jump right into our agenda. First, we'll look at the 346% revenue explosion. Second, we'll get into high-bandwidth memory explained. Third, the $100 billion bull case. Fourth, the bear case risks. And finally, volatility and covered calls.
Part 1. The 346% revenue explosion.
Now, what's really interesting here is the massive magnitude of the beat across every single meaningful metric. Wall Street analysts were expecting Micron to bring in a very healthy $35.25 billion in revenue. Instead, Micron dropped an astonishing $41.46 billion. That is a beat of more than $6 billion in just one single quarter. Adjusted earnings per share came in at $25.11, absolutely crushing the $20.28 estimate. But the most critical number by far is gross margin. In the hardware and memory manufacturing business, building physical chips requires extreme capital expenditure. We're talking about buying EUV lithography machines that cost hundreds of millions of dollars each. Because of those heavy costs, a normal, healthy gross margin for a memory company usually sits right around the high 20s. Exactly 1 year ago, Micron's gross margin was exactly that. Roughly 27%. This quarter, it came in at roughly 84.6%. I really want that to sink in for a second. Achieving an 85% gross margin in physical manufacturing implies you have virtually infinite pricing power. Your customers are literally paying whatever you demand.
To really anchor this data and put that growth into perspective, the leap we're seeing here is just incredible. Just a year ago, they were sitting at $9.3 billion in revenue. Fast forward to today, and they're at $41.5 billion. But what actually sent the stock rocketing up double digits wasn't just the past performance, it was the future guidance. Micron told the market to expect $50 billion in revenue for the next quarter. Wall Street's consensus model was only looking for $44 billion. Now, in the semiconductor industry, executives are notoriously conservative with their forward guidance. Supply chains are incredibly fragile, and one slight hiccup can totally ruin a quarter. So for a management team to guide a full $6 billion above Wall Street's expectations, that is a massive flex of confidence. It tells the market they have absolute ironclad visibility into their future demand.
Part 2. High bandwidth memory explained.
To really understand this financial explosion, we have to deep dive into the underlying science and physics of what they're actually building. Think of a high-speed fuel line. That brilliantly illustrates the exact piece of technology changing the world right now, HBM, or high bandwidth memory. The AI conversation is obviously heavily dominated by NVIDIA GPUs. Think of the GPU as the ultimate superbrain doing complex calculations. But a brain is completely useless if it cannot access information fast enough. In computing, physical distance equals latency. The farther an electron has to travel, the longer it takes to process data. HBM solves this massive physics problem using a technology called TSV, or through silicon vias.
Instead of laying memory chips side by side on a motherboard like they used to, manufacturers now stack 8 to 12 memory dies directly on top of each other, like a skyscraper. They then punch microscopic holes straight through the silicon, filling them with copper to connect the layers vertically. This ultra-dense tower of memory is then mounted directly next to the GPU on the exact same package. By fundamentally shortening the physical distance the data travels, HBM achieves incredibly low latency, pumping massive amounts of data into the GPU. I'm not exaggerating when I say that without HBM, the AI revolution literally grinds to a halt.
But here is where the physical science creates a massive economic bottleneck that is genuinely mind-blowing. Manufacturing this highly specialized HBM is incredibly complex and resource-intensive. Producing a single gigabyte of HBM requires approximately 3 times the factory wafer capacity as producing a standard gigabyte of normal memory. This means that as Micron and its rivals rush to retool their fabrication plants to build HBM for massive AI data centers, they are rapidly eating up the exact same factory capacity that used to make the regular memory chips for everyday consumer devices. They are effectively starving the traditional market of supply. This trillion-dollar macro trend is directly impacting your wallet right now. Because HBM is monopolizing factory space, regular DRAM prices have spiked over 200%. This is exactly why the average smartphone price jumped to a record $523 this year. The data center AI boom is literally making the phone in your pocket more expensive.
To fully grasp the opportunity, we have to contextualize the competitive landscape. As of 2025, the market leader in HBM is South Korea's SK Hynix, commanding a dominant 61% of the market. Micron sits in second place with roughly 21%, followed closely by Samsung at 17%. Now, while Micron is fighting against much larger rivals for market share, we also have to look at the geopolitical angle. Micron is the only US-based leading-edge maker of this specific memory. In an era where the CHIPS Act and national security are inextricably linked to semiconductor supremacy, having domestic production is a massive structural advantage. And remember, this isn't a stagnant pie. The HBM market is projected to hit $100 billion by 2028. There is more than enough demand to fuel massive growth for all 3 players. Right now, Micron's CEO has explicitly stated they are completely sold out for the year. You couldn't buy more right now if you tried.
Moving on to Part 3, the $100 billion bull case.
Historically, the memory chip business is famous for being a brutal, cyclical boom and bust industry. So the crucial point is how Micron has engineered their way out of that vulnerability. Micron has signed 16 strategic customer agreements stretching all the way out to 2030, guaranteeing a minimum of roughly $100 billion in revenue. These are take-or-pay contracts with built-in price floors. That means big tech companies must pay for these chips at a minimum price whether they use them or not. But here is the most astounding part. To secure their spot in line, these customers have handed over $22 billion in upfront prepayments. In the hardware world, customers acting like banks and fronting cash years before delivery is incredibly rare. When you combine this locked-in demand with the physical reality that new factories literally don't come online until 2028, you have a mathematically guaranteed supply shortage that fundamentally de-risks the historical boom and bust cycle.
Which naturally leads every investor to ask themselves one simple question. Is it too late to care? If a stock has gone up nearly 700% in a single year, climbing from a low of around $103 to over $1,200 a share, hasn't the market already priced in all of this fantastic news? Is all the upside completely gone? Well, let's look at the actual valuation models.
This reveals a truly incredible valuation paradox. On a trailing basis, meaning looking backward at earnings over the last 12 months, Micron trades at a multiple of about 27.4. That sounds fairly valued, right? But the stock market is a forward-looking discounting mechanism. When we look at the forward PE using expected earnings for next year, the stock trades at a remarkably low multiple of just 8.5. To take this a step deeper, as experts always should, we have to look at the discounted cash flow, or DCF model. A DCF model projects a company's future free cash flows and discounts them back to their present value to find a stock's true intrinsic worth. When analysts plug $100 billion of guaranteed revenue at an 85% gross margin into a 5 to 10-year DCF model, the math screams that the stock is a massive buy. Based purely on the DCF, a stock up 700% is actually considered fundamentally undervalued right now because the underlying cash generation is growing at a much faster velocity than the stock price itself. But that intrinsic value holds true only if those massive projections don't crack.
That brings us to Part 4, the bear case risks.
Let's walk through the bear case impartially because we have to look at both sides. Risk number 1, Economics 101 dictates that an 85% gross margin is an absolute magnet for fierce competition. Rivals will move heaven and earth to add capacity and steal that market share. Over time, margins that high always face massive downward gravity. Risk number 2, capital expenditures, or CapEx. Micron just raised its spending on new factories to over $25 billion. Why is this deeply dangerous? Because semiconductor fabrication equipment ages and depreciates rapidly. If the AI hype slows down and demand dries up, Micron is left holding a massively expensive bag. The depreciation expenses on those idle factories will drag down their income statement and completely wipe out earnings for years. Risk 3 is that the stock is priced for sheer perfection, leaving absolutely zero room for error. And finally, volatility cuts both ways. You can easily drop 20% in a single day on a slightly soft quarter.
Which takes us to our final section, volatility and covered calls.
Right now, the implied volatility on Micron options is sitting at roughly 96.2%. Just a quick reminder, options carry significant risk, and this segment is strictly educational, not financial advice. In the options world, a 96% implied volatility means the market is essentially in a state of extreme anxiety. Why? Because of binary events like earnings calls. Options market makers refuse to be caught holding the bag if a stock gaps up or down 20% overnight, so they crank up the implied volatility, effectively charging an absolute fortune for insurance on the stock. If you are buying options in this environment, you are paying a massive inflated premium. But if you are selling options, you are the one stepping in as the casino, collecting that outsized cash premium.
Let's move to see how this builds into an actionable, albeit advanced, strategy called the covered call. This is how some investors actually use high volatility to their advantage. Step 1. You must already own 100 shares of the underlying stock. Step 2. You sell one call option contract at a strike price higher than the current market price. Step 3. Because implied volatility is way up at 96%, you collect an elevated cash premium up front, basically like collecting extra rent on a house you already own. However, step 4 is where the deep risk lies. You must accept a mathematically capped upside. Let's look at a quick hypothetical. If you sell a covered call at a $1,300 strike price and the stock absolutely rockets to $1,500 on good news, your shares will be called away. You are forced to sell them for $1,300. Yes, you get to keep your initial premium, but you completely forfeit that $200 per share of pure, unexpected upside profit. In a momentum market, capping your upside is a really severe trade-off.
As we bring this deep dive to a focused close, we have to distill all these complex dynamics down to one thing. We've talked about the microscopic TSV physics, the $100 billion in prepaid contracts, and the heavy capex depreciation risks, but the single most important metric you need to watch, the one number that decides this entire debate, is gross margin. As long as margins stay up near 85%, the bull case and that beautiful DCF model are alive and well. It proves that pricing power remains absolute. But if in the coming quarters you see that margin slip down to 75% and then 65%, that is the definitive signal that supply is catching up. If margins drop to 65%, the future cash flows in that DCF model collapse entirely, and the stock price will correct violently.
I will leave you with this final, provocative thought to ponder today. Has the advent of AI and the physical constraints of high-bandwidth memory manufacturing actually created a permanent, new, structural baseline for chip profits? Or are we simply staring at the absolute peak of a classic hardware cycle that is inevitably about to turn? I really want to hear your thoughts, so let me know in the comments. Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities. Thank you so much for exploring the science and the data with me today, and I'll catch you in the next explainer.